Hello, everyone, and good evening. Today is June the 14th, 2024. Just to let you know, this is pre recorded on today, and hope everybody is doing well. Back here again with Money Minded on Soul Sisters 10X platform. And tonight we are going to be talking about debt consolidation. Okay, debt consolidation. We'll jump right into it. We know what debt is. It's when the money that you owe out and you have to pay back and things like that. We accrue debt. Everyone has some form of debt, whether it be a car payment, mortgage, a personal loan, student loan, streaming services, a cell phone bill, all those bills that you pay are debts, things that you owe. But we really try to do is get those debts down to the basic needs that you need in your everyday life, as far as your mortgage, your car. There's good debt, bad debt. We talked about all of those things already. So tonight we're going to talk about consolidating those debts. Okay, so you should have a pretty good idea of what you owe, who you owe it to, and how much it is. All right. So when you look at those debts, you want to start looking at the thing at your interest rates. Okay. So you want to look at, say you have multiple credit cards, and you want to look at those interest rates and see how much those interest rates are. And they can be anywhere from, my goodness, 18% up to 30, 35% per card. Okay. So a lot of times, let's talk about interest rates for a little bit. So a lot of times, when we accrue this debt, they tack on a debt. So they tack on an interest rate. So if you have a credit card and you go out and you don't have the money to pay for that item, but you want it, you need it, whatever the case might be, and you purchase it right now, that's fine and dandy. That's great. You go out and charge $100, and next month you don't have the whole $100 to pay. They're going to tack on that interest. Okay. So that's what interest is. So for an example, we'll use that $100. If you use $100 and the minimum payment is $15 and you pay that $15, they're going to tax interest on that other $185 or that $85 that you still owe. Okay. So you would take $85 and you will multiply it if it was a 35% rate. I'm gonna figure that out right now here in a second if I can get my phone to come on. um, we'll figure out the math. Okay, so that's why I don't like iPhones. Work, there we go. It's taking too long to face recognition. So anyway, if you take that 85%, if you take that 35% and you multiply it by that $85, so you would go 85 times 35%, 0.35. You would owe another $29.75. So your original amount that you charged was $100. You only paid $15 on it, which is great, but you're not even paying down the debt, because now they're going to add $29.75 to the $85 owing more than the $100 you charged in the first place. Okay. So this is, and that's at a 35% interest rate. I know, if you're watching or whatever the case might be, you say, well, a lot of credit cards don't go that high. They do. The interest rates are very, very high, and some credit cards can go up to 35% in charging you interest rates. Okay. So you want to take your debts and you want to look at it and look and see how much interest you're paying for each one of those debts. So that's when we get into debt consolidation. Okay. So what does debt consolidation mean? Consolidating your debt is an act of taking out a single loan or a single credit card to pay off multiple debts. All right. So if you got 5 or 6 credit cards and you have a personal loan, you may want to consider consolidating those bills together so you only have one debt and one interest rate instead of having all of those different interest rates. Another good example of that is student loans. I too myself just went through this, and I consolidated my student loans into one bill. And when I first initially looked at it, I said, no, I'm not going to do it, because I looked at the interest rates for each of them, and some of them were higher than others. But as I started to pay them, I said, this doesn't make sense. Let me just consolidate them. I'll get one. And over long term, when I did the math, I realized that consolidating them would be in my best interest, and I would save money on that interest rate. Okay. Another explanation I found of debt collection or consolidation is the process of taking multiple debts with a new loan or balance transfer from a credit card, often to a lower interest rate. So when I look at those definitions, again, it means the same thing. You're taking a look at all of your debt and you're consolidating it into one bill, basically, is what you're doing. So you're taking all your credit cards, you may have a loan, or whatnot. You're taking all that debt and you're just going to consolidate it to one account, one bill, one debt, one interest rate. All right. So again, how do we know if this is a good thing to do? Again, do your homework, do your math, the same way I did for my student loans. At first, I was like, no, it's not. Some of them were 4. I had some as low as 3 or 2%, but I had a couple that were as high as 7 or 8%, and those were the higher amounts that I owed, had that higher interest rate. So even though trying to pay those down or whatnot, I'm still paying over long term. I would be paying more in interest by not consolidating. So I consolidated them all, and I was able to get an interest rate of 4% for all of it. So over the time that it will take me to pay off the student loans, the interest rate is only 4%. So it's cheaper that way. Okay, so do your math, do your homework, and make sure consolidation is good for you. I know a lot of time people think of debt consolidation. This is different. You want to keep in mind it's different from when if you're in collections and you go to a collection agency and they try to get you a deal or something with that credit card company, or to try to get them to wipe off some of your debt. That's a little bit different. Debt consolidation does not hurt your credit score as bad. It will affect it a little bit because those accounts that you had open will now be closed, because now you have one account and then you're opening a new account. So you got to keep in mind what makes up your credit score. So it will affect your credit score a little bit, but the points that it affects your credit score with is not that detrimental to your score. It should not jump it or lower it that bad. Okay, maybe 10, 15 points, depending on your debt, depending on what rate you get, and that kind of thing. So it depends on where you stand. But if you're pretty good standing, don't be afraid of debt consolidation, especially if you have an end goal in mind. We've been preaching and talking about goals since I started this. And if one of your goals is to pay down debt, you want to be debt free before you retire, you want to just be able to save more, whatever your ultimate goal is, that's what you want to do to make sure that that fits best for you when it comes to debt consolidation. Okay. So then now you thought about it, you want to go into do your debt consolidation. How does it work? What do I do? Okay, what do I need to do? I looked at all my debt. I figured I do want to consolidate it. So what's next? What's my next step? There's a few things that you can do to consolidate your debt. All right. One of the first things that you can do is take out a personal loan. All right. Now, to be able to take out a personal loan, make sure that you have a pretty good credit score and that you're in a place that you will be able to get the loan for the amount that is due. Okay. So that's the first thing you want to do. You want to make sure your score is good. You're in pretty good standing and say, okay, I'll be able to go get this loan and I will be able to, I qualify for getting a personal loan and they will approve me and I'll be able to get them the loan for the amount that's due. All right. Now, when you do that, make sure that the interest is going to be less than what you're already paying. There's no sense of you consolidating all your debt and you get a personal loan and your credit score is not where it needs to be. And they say, sure, we'll give you a $10,000 loan, but your interest is going to be sky high or higher than where you are. There's no sense of you getting that loan. You're not making it, doesn't make sense. Okay. So again, make sure that the interest rate is lower than the average of all of your debt. All right. And that's the case, then you can apply for your loan. Okay. You're going to use that loan to pay off your debts. You're not going to go out shopping. So that means you got to be disciplined and pay off your debt with that loan. All right. And then your goal from there, once you get the loan, is to pay off that loan. So you got to make sure that you want to find out how much the loan payments will be every month, how long the loan is, depending on how much you owe and how much you're willing to pay. Sometimes they'll work with you. Banks and things will work with you. And they'll say, you go there and you speak to a representative. I'm looking to take out this personal loan because I want to pay down debt. In some cases, they might even disperse the amounts to each creditor for you. So you would want to know that, and then what your monthly payments would be and when they are. A lot of people don't realize that either. I know sometimes it seems like the first of the month comes and all the bills are due. You can go in and you can do a lot of this can be done right on the app online. You can request a new payment date. A lot of people don't realize that, but you can. Okay. So I would go on, and if you don't know how to do it on your app or whatever the case might be, call the customer service representative and you can see if you can get a new date. All right. So even when you're taking out that loan, all right, I want to take that loan out. This date would be great for me. Another thing you can do is set up automatic payments right then and there. So I want to consolidate my loans. Okay. I can afford to pay this much. They'll tell you what they can do for you. And you say, okay, on the 3rd of every month, I want that loan payment to automatically be taken out of my account. All right. And again, that's being money minded. That teaches you discipline. Set a reminder on your phone, put it right in your calendar a week ahead whenever you get paid or whatnot. Realizing on the 3rd of the month, X amount of dollars is coming out for this personal loan every month. And you can do it occurring. You can do it if you have Outlook. You can do it on Outlook email. However you organize yourself, okay, so that you know that amount is coming out each and every month to pay down that debt. All right. Now, so what happens to those closed accounts? If you close the account, now we got to keep this in mind too, because if you're going to take a personal loan and you're paying off credit card debt, number one, do not go out and spend more money on those credit cards. Discipline yourself. If you cannot trust yourself, my recommendation would be to don't close the account, but cut the credit card up. Okay? Cut the credit card up. Don't report it lost or stolen, whatever. That way you don't have it and you won't be tempted to go out and say, oh, well, I paid that off. There's nothing on it. Because what's going to happen is you're just going to keep staying in that same habit and you'll never be money minded. You'll never get yourself out the debt. Okay. So either do that. I've heard people say out of sight, out of mind, lock it in the safe. After a little while, you were teaching yourself actually on how not to use that credit card. Because I want to reiterate, there's no sense of doing this and you're going to go out and consolidate debt. You're going to go out and make more debt. You don't want to do that. And that's where consolidation, that's a con. That's a bad thing of consolidating your debt when you do that. Don't do that. Get that right out of your mind. All right. But our goal is to pay down debt and to consolidate so we can have one bill at a lower interest rate and we can get that paid off. All right. Sometimes you could stretch it out over a 5-year period, 6-year period. I'm hearing now that even car loans are 7 or 8 years because newer cars are costing more money. That kind of thing. So it depends on the institution. The best thing to do is to start with the bank that you bank with. Most of us get paid direct deposit now. Nobody's picking up paychecks or anything like that. So they see your credit union. We were talking about this with some of the saints at the church the other night. We love our credit unions that we're with. your bank system, and if you've been with them for a long time, what happens is they learn your habits. They know that you shop at Walmart once or twice a week because that's the habit of you using your debit card. They see that kind of thing. So, and when they're watching and paying attention to your history, sometimes it's easier to get a loan right through the institution that you do your banking with because they know your habits. They know if you're a good spender or they know if you're a bad spender. They know if you're money minded. They know if you can constantly overdraw. So basically, what I'm saying is they understand and know the risk of giving you a personal loan just by your behaviors, your action, on how you spend your money. Okay. Again, so the next thing here says it here is it a good idea to do a debt collection? It's usually a good idea if you have high interest loans, if you have high interest rates. Um, I'll give you another example of we'll use a car. If you got a car loan a couple years ago and your credit wasn't that great, you've been working on your credit and you got your credit score down. A lot of people are afraid of refinancing. And sometimes, depending on institution, refinancing may cost you money. Oh, we'll refinance you, but you got to pay us $200 or $300 to do all the paperwork and stuff or things like that. Again, this is another time I would encourage you to look into debt consolidation because if you paid on it a little bit now, your credit score has gone up where you can get a lower interest rate on a personal loan. You can pay that car off and add to it 2 or 3 credit cards and pay all that debt off and just have the one bill with a lower interest rate. All right. But again, to do this, you got to be money minded. Got to be conscious and definitely do your homework. Okay. You do want to think twice before you do it. You do want to make sure it makes sense. Again, I said no when I first looked at it, and I've been paying on these student loans for a little bit, and I said, okay, Sharon, this doesn't make sense. Let's do the math, and it is better to consolidate those that have that lower interest rate because again, one thing that I've learned too is whatever loans whatever you owe debt you owe, you want to start with your smallest one and pay that off first. Not that you're ignoring your other ones, but in my case, the bigger ones had a little bit of higher interest rate, a 6 or 7%. So I'm paying off the little ones with 2 and 3%. I'm gaining all these interest, and I'm going to wind up paying on my higher student loans more money at the end, where now I just consolidated them all and I'm an average of 4% interest. Okay. So think twice, do your homework, make sure it makes sense when you do it. Okay. So some of the pros again of paying off or getting a debt consolidation, some of the pros are you'll be able to pay off your debt earlier. All right. Again, we're talking about that car loan. That car loan might be an 8-year car loan. You've paid it for 2 years, right? But now you got your credit score up and it's better, and you can get a lower interest rate, being able to get that personal loan instead of doing that car refinancing that car loan at a lower interest rate. Instead of having 6 years left, you may be able to pay it off in 4. It depends on what the interest rate is. Okay. So that's a pro. So paying it off earlier, your interest rates should be lower. There's no other way I can explain it than that. If the interest rate's not going to be lower than what you're already paying, there's no need for you to do a debt consolidation. Debt consolidation is to help you to lower your payments, to lower the interest rate, to pay off the debt. All right. It could reduce, again, I just spoke about that, reduce how many months you're paying. And it also can help your credit score. Okay. Because again, with those credit cards, if you consolidate those credit cards, all right, what is it going to consolidate? So you got $10,000 in credit card debt, but you get a personal loan for $10,000. You're paying those credit cards off. Your credit card usage score goes down because now you have zero balance on it, which is going to help your credit score. Your credit score is going to go up because they're going to say, hey, you're not using those credit cards anymore, and you're under that 30% threshold because you paid them completely off. So that's going to help improve your credit score. Okay. Some of the cons that are in debt consolidation, some institution may charge you a fee. Like I was talking earlier about refinancing. I know sometimes if you refinance, there's some legal fees or whatnot because they got to drop all the new paperwork, things like that. Again, another example, bought it in 2019. 2020 COVID hit. We know the economy was bad. Everything went down. Um, Mortgage, nobody was buying homes. People were losing jobs. Very, very hard time for the economy as well. So my mortgage company actually called me and to keep things going and to help people with new loans or just so you wouldn't default or whatnot. They were offering refinancing at a lower interest rate with no fees. So I took advantage of that, and when I was able to knock 10 years off my mortgage for a few extra dollars a month because of COVID. Okay. So that was a great opportunity for me and I took it and it didn't cost. But sometimes when you do debt consolidation, there are fees. So be careful with that. All right. Sometimes, sometime with debt consolidation, there are higher interest rates. If it's a higher interest rate, I would not suggest to do it. There's no sense of taking out a loan or paying more. Again, our goal is to pay down debt or pay off debt. Okay. Check and see if you're going to pay more interest over time. For this one, I'll use my college loans again. So, yep, I had those higher ones, but I had to do the math. How many years is it going to take me to pay off my student loan? And at this much interest for this much, and right now I'm concentrating on this. All right. Does it make sense? That's why I said to do your homework. All right. Because if it's going to be more, if you're going to consolidate your debt, but you're going to wind up paying more interest over time, if it's going to take you longer, then it's probably the same, or you'll probably wind up paying more in interest. Okay. So time does make a difference. Your factor, how many months, how many years that it's going to take you to take down that debt, pay off that loan. If it's a longer time and you'll be paying more interest over time, that's not a good idea. Okay. Also, I mentioned making sure that or doing automatic payments. There's no sense of you doing a debt consolidation and now you start missing a payment. You're late on a payment. What's going to happen? You become another risk. Okay. And then you're going to get late fees accommodated to it. And all these other fees are going to happen, and then you're going to default in your payment and it's going to hurt your credit score. So if you are not money minded, if you don't have it in your mind that you could stick to this plan, that you can stick with making sure that you pay this debt off, it would not be a good idea to take on the consolidation. Okay. And I already talked about this one too. It says it may encourage increased spending. If you decide to get that consolidation loan, pay off those credit cards, do not go back out and charge those credit cards again, because now you just got another loan and you're just making more and more bills for yourself. And that's not what you want to do. Okay. So if it doesn't make sense, then don't do it. If it doesn't, and the math ain't mathing, amen, and one plus doesn't equal 2 in it, then don't do it. You really have to be disciplined and be money minded when you're talking about consolidating debt. Okay. When is it a good time to consolidate debt? If you just have your regular bills, your mortgage, your car payment, things like that, I wouldn't bother. If you have a lot of debt, if you got a lot of credit card debts, student loans, and if you want to, then if you want to throw your car in there or something, then I would suggest time to look at it. All right. When it gets overwhelming, when you're paying, you got 10, 12, 15 people you're paying every month. All right. You want to look into consolidate it. How can I get this down? How can I simplify it for me? So that's something that you want to look at. All right. If you're having a hard time keeping up with them, if you can only pay, say you only have 5 credit cards, but you can only pay 5, the minimum balance on all 5 of those. That's the time that you want to take a look at it and say, well, hey, if I can consolidate, would I? All right. So I talked a lot about personal loans the last few minutes here. I want to talk about a credit card. So if you credit score is better, you have credit cards, okay, and you want to consolidate, it's okay to consolidate with another credit card. But the things that you want to look for, you want to look for those credit cards that have 0% interest for maybe 12 to 24 to 36 months. Okay. So that way you can transfer the balances from the credit cards that you have over to that card. And just by doing that, and it has 0% interest, 12, 24, 30, and you are saving a lot of money. Imagine that 35% over that 1 or 2 year period every month that you'll be saving on each one of those credit cards. So that's what you want to look for. Number one. Number two, when it's over, when that 0% interest is over, what is the interest rate going up to? Okay. So a lot of them say, oh, it's 0% interest for 12 months. Okay, after the 12 months, what is the interest rate on that card? All right. And then your goal should be to try to pay off as much of that debt that you can within that 12 months. So we'll go back to, we had those 5 credit cards, and we found a credit card that we were able to get, and our credit score was okay and whatnot. And we can now transfer those balance over to that credit card. So all those minimum payments that you're paying on those 5 credit cards, now you have that one. You want to take all of that, and then if you can, add to it, because you want to pay that debt down as much as you can before that 12 months is over. Okay, because once that 12 months is over, that interest rate might be 16 or 17%. So you want to keep an eye on that. Okay, make sure you have enough cash flow that can cover the debt. You have enough money coming in to be able to pay that. And again, do not go out and continue to spend money on those credit cards and add to it and make more debt. Debt consolidation is only for money-minded people that are going to discipline yourself, and that you're looking to pay down debt. You're not looking to incur more debt. You have a goal in set, and you want to really get those bills paid off. Okay, so that's our session for tonight on debt consolidation. I hope you enjoyed. Again, if you ever have any questions, or if you want to know more about it, if you want me to speak more about it, just drop me a comment, shoot me an email, or a message, whatever the case might be, and we'll definitely help and get back to you. All right. Just a quick announcement: there will be no Money Minded next week, as I am hosting the MOF conference next week, and next week's going to be pretty busy with me. So I will be back with you. I believe the date is on the 28th, Friday, the 28th or the 29th. Let's see, the 20, I think, yeah, 28th or 29th, whatever that Friday is. All right. God bless you. And remember, if you give the Lord his 10%, you put God first, give him tithes and free will offering, he will open you up a window and pour you out a blessing that you won't have room to receive. God bless you. Be more minded, continue to be money minded. God bless you. And until we meet again, have a good night.